Look, I think anytime you provide investors with a certain amount of information and withdraw it, you're going to receive some criticism for that. But quite frankly, I think that's the red herring here. I think the real issue is that if you work from Apple's guidance, they're saying effectively, or we impute, that iPhone units are going to decline 5 to 10% in the December quarter. And that is really the key controversy going forward, which is, can you have a healthy Apple if iPhone units are going to decline going forward? Now, you may say, well, they're getting price increases, revenues are still going to increase this year. But if units do go down this cycle, and it looks quite likely that they will, that's saying the market is effectively saying, we're not sure that we can take price increases from you anymore, Apple. And so if iPhone prices don't go up and smartphone units are down this year and will likely continue to be down, then all of a sudden you're talking about 60+% of the revenues of the company that are going down. And if units aren't fueling the installed base drives services growth, all of a sudden you have a different story. So that's really the controversy. It's not so much that they withdrew units. People really view the withdrawal of unit information as a validation that units are going to be weak this year. But the issue is all about, if units are weak on iPhone, what is that saying about the sustainability and health of that business and the sustainability and health of the growth of the installed base?
So you've cut the price target. You kept your market perform rating. Should let everybody know that first and foremost. But you've cut the price target from $225 to $210. Much was made, Tony, when you made a statement on this program some time ago that Apple's best days were behind it. Can you say today that Apple's best days as a stock are behind it?
Yeah, I mean, look, absolutely. And it's not a fault of Apple's. It's important that it's a relative statement. And the relative statement is, you had a stock that went up, 15-fold in 10 years. That's not going to happen going forward. It's impossible on a $275 billion revenue company to have that kind of growth.
These are two kinds of, forgive me for interrupting, I apologize, but they're almost two kind of different conversations. I'm not necessarily suggesting that you can see the same sort of stock growth that at that rate that you've seen in the past. But we're also talking about a stock that's not all that far away from its all-time high. Are you worried that those days are behind Apple, that this is no longer going to be a story where Apple hits a new high this month or hits a new high that month, that we need to start rethinking as investors about what this stock can truly deliver?
No, I don't think that's the case, Scott. This is a company that has lots of assets. This is a company that can grow earnings by introducing new products. This is a company that's buying back a lot of its shares, which can help earnings per share. So I certainly don't think that we've hit the high point in Apple's share price on a go-forward basis. I think there will be an investor debate, and that's what you're seeing in the market's reaction today, about whether lower unit growth this year is portending something more structural going forward. And again, it's not black and white. I think, the market was expecting units to be flat and ASPs to be strong. ASPs are going to be strong, but units are going to be down. So the market's recalibrating that. And really the core strategic question is this one about what is weaker unit growth saying about how consumers are responding to Apple's prices? And what does that mean about future unit growth and its implications for services growth?